You are 70, or approaching it. Your working years are behind you, or nearly so. And suddenly, the rules of the game have changed completely. The very strategies that built your nest egg, aggressive growth funds, taking on risk for reward, can now destroy it. One bad recession at the wrong moment in your life isn't a setback. It's potentially irreversible. Analysts who have spent years dissecting Berkshire Hathaway's letters, its portfolio moves, its capital allocation decisions, have found a recurring pattern for exactly this life stage. A pattern so simple it will make you angry at the financial industry for how deliberately overcomplicated they have made it. By the end of this video, you will know the 3 specific investment vehicles that the Buffett Doctrine identifies as the safest, most appropriate homes for your capital after 70, not in theory, in precise, actionable detail. Let's be honest about what brought you here. Maybe you've sat across from a financial advisor who buried you in jargon, diversified alpha, risk-adjusted beta, alternative asset class exposure, and you walked out with a $10,000 annuity you didn't fully understand and a vague, uneasy feeling in your stomach. Maybe you've watched your peers chase dividend stocks or get burned by market volatility at precisely the worst moment, right when they needed the money most. Or maybe you've simply Googled safe investments for retirees and received 10 articles contradicting each other, half of them quietly sponsored by fund managers who charge 1.5% in annual fees, compounding against you. You don't need another feel-good platitude about diversification that says nothing. You don't need motivational noise or abstract theory wrapped in a ribbon. And you absolutely do not need a get-rich scheme disguised as retirement advice. What you need is what research into the Berkshire Hathaway model has consistently revealed: a simple, proven, unglamorous blueprint built on actual principles that have withstood bear markets, recessions, inflation spikes, and black swan events. This video is exactly that, a structured, step-by-step breakdown of the 3 investment vehicles the Buffett Doctrine endorses for those over 70, why they work at this specific life stage, and precisely how to implement them, with real numbers, real context, and zero fluff. And let's get into it. Here is the lie you have been told, probably more than once. You're too old to build wealth. That statement is not only factually wrong, it is exactly backwards, and here is why. Research into the Berkshire methodology reveals 3 specific structural advantages that a retiree over 70 possesses that a 30-year-old investor literally cannot replicate regardless of their income. Advantage number 1, you have already won the war against compounding debt. A 30-year-old investor, statistically speaking, is simultaneously trying to build wealth while servicing a mortgage, car payments, student loans, credit card interest, and growing a family. Their capital is being pulled in 14 directions at once. Every dollar they invest is fighting against multiple streams of interest flowing the other way. You, at 70 or beyond, in all likelihood, have cleared most or all of that battlefield. The mortgage may be paid. The children are independent. The financial anchors that dragged every dollar down for decades have been cut loose. A core tenet of the margin of safety principle, as analyzed in Buffett's letters, is that the greatest returns come not from spectacular gains, but from the ruthless elimination of losses. When you are no longer hemorrhaging capital to debt service, the compounding math shifts violently in your favor. A portfolio that earns 7% annually and loses 0% to consumer debt interest is structurally superior to a portfolio earning 10% while losing 8% to liabilities. Your zero debt position is not a retirement cliche. It is a compounding weapon. Advantage number 2, you have clarity. The market gives no clarity to the young. At 30, you don't know your income trajectory. You don't know whether your job is secure, whether your industry will be automated, whether your family will expand, or whether a medical emergency will upend everything. You're investing into a fog. At 70, the fog has lifted. You know, with a level of precision unavailable to younger investors, approximately what your monthly expenses are, what social security or pension income arrives, what your healthcare costs look like, and what your time horizon actually is. The Buffett Doctrine operates on this principle relentlessly. You should only make investment decisions on things you genuinely understand and can analyze with confidence. The 30-year-old investor must make guesses about almost everything. You do not. Your financial clarity is a form of analytical edge. The analysts call this known liability matching. When you know precisely what you need from your portfolio, because your expenses are largely fixed and predictable, you can engineer an investment structure that serves those exact needs. This is not a consolation prize. This is the foundational principle that institutional endowments and pension funds worth hundreds of billions of dollars operate on. You have stumbled into it naturally. Advantage number 3, you are immune to the psychological trap that destroys most investors. The single greatest destroyer of retail investor wealth is not a market crash. It is the behavioral response to a market crash. The panic selling, the capitulation at the bottom, the buying back in at the top after the euphoria returns. This is the wheel that grinds most investors to dust. Men research into Berkshire Hathaway's methodology consistently reveals that Buffett's greatest skill has never been picking stocks. It has been his near-pathological ability to sit still while the world panics. His famous statement, paraphrased, is that the stock market is a mechanism for transferring wealth from the impatient to the patient. At 70, with a properly structured portfolio, we will describe in precise detail shortly, you have a buffer in cash and short-term bonds. That means a market crash does not force you to sell equities. You do not need to panic. You have 12 to 24 months of living expenses sitting safely in cash, completely insulated from the market's mood swings. The 30-year-old investor living paycheck to paycheck, margin called on their brokerage account, watching their net worth evaporate in real time. They are the ones who sell at the bottom, not you. Your age, your stability, your known expenses, your cleared debts, these are not retirement disadvantages. Properly understood through the lens of the Berkshire methodology, they are your most unfair structural advantage in the market. And now, before we get to the blueprint, comes the part most people skip, because they don't like what it says. Let's pause here, because what comes next requires something from you. A study by Dalbar, one of the most respected financial research firms in America, found that over a 30-year period, the average retail investor earned roughly 2.9% annually, while the S&P 500 returned approximately 10.65% annually over the same period. Read that again. The market returned 10.65%. The average investor captured less than 3%. The gap wasn't caused by bad stocks. It was caused by bad behavior, buying high, selling low, chasing last year's winner, listening to their brother-in-law's hot tip, paying 1.2% in management fees to an advisor who underperformed the index. Anyway, here is the uncomfortable truth. Knowing the right strategy is almost useless if you lack the discipline to execute it with grinding, boring, unrelenting consistency. Let's call out the excuses. Right now, before your brain manufactures them. The economy is too uncertain right now. The economy has been uncertain in 1929, 1973, 1987, 2000, 2008, 2020, and every year in between. It will always feel uncertain. That feeling is not data. I'll start repositioning my portfolio after the next market correction. No, you won't. Because when the correction comes, you'll be terrified and you'll wait for the bottom. And when the bottom arrives, it won't feel like a bottom. It'll feel like collapse, and you'll wait for it to worsen. I need better returns than 7 to 8% annually. I can do better. The Buffett principle answers this clearly. The investor who earns a consistent, modest return with capital preservation, without catastrophic loss, will systematically outperform the speculator chasing 20% returns, who periodically wipes out 40% of their principal. The math is unambiguous. The price of admission to this blueprint is this: the willingness to be boring, to resist the adrenaline of speculation, to hold an index fund through a 35% drawdown without selling, to keep 18 months of cash untouched even when it feels like dead weight. If you are not willing to pay that price, and if you need excitement, if you need to feel like you are doing something with your money every quarter, this approach is not for you, and watching further is a waste of your time. Still here? Good. Then let's build the architecture. Pillar 1. The low-cost S&P 500 index fund, the purchasing power engine. Allocate the substantial majority of your investable portfolio. Buffett's documented guidance suggests approximately 90% into a single ultra-low-cost S&P 500 index fund. Specific metrics. Look for a fund with an expense ratio at or below 0.05% annually. Vanguard's VOO and Fidelity's FZROX are representative examples of the category. On a $500,000 portfolio, the difference between a 0.05% fee fund and a 1.0% advisory fee fund is $4,750 per year. Over 15 years, at 7% growth, that differential compounds to over $120,000 lost, not to the market, but to friction. Gone. Permanently. Actionable. Example, if your current portfolio sits in an actively managed mutual fund, charging 0.85% annually, calculate what you have paid in the last decade. Take that number, write it on a piece of paper, and let that discomfort motivate the transfer. Moving to a low-cost index fund is not a complex transaction. Most brokerages allow electronic transfer of assets within a few business days, countering the objection. But won't the S&P 500 crash and wipe me out? The S&P 500 has never, not once in its history, delivered a negative return over any rolling 20-year period. And, critically, because of Pillar 2 and Pillar 3 in this architecture, a market crash does not force you to sell a single share. You draw from your cash and bond buffer while equities recover. Volatility without forced selling is not risk. It is temporary paper discomfort. The psychological shift. The moment you understand that you own a fractional piece of the 500 greatest companies in American commerce, companies with pricing power, global reach, and institutional permanence, market headlines stop feeling threatening. The market's daily moods become background noise. You stop being a speculator and start being an owner. Pillar 2. Short-term U.S. government bonds, the fortress of liquidity. Allocate approximately 10% of your investable portfolio to short-term U.S. Treasury bills, specifically instruments with maturities of 3 to 12 months. Specific metrics. On a $500,000 portfolio, this represents $50,000 in T-bills. At recent yield levels, the short-term T-bills have returned between 4% and 5.3% annually, risk-free, backed by the full faith and credit of the U.S. Treasury. That is a guaranteed $2,000 to $2,650 per year on your bond allocation alone, with zero default risk. Actionable example. T-bills can be purchased directly and without commission through treasurydirect.gov or held via low-cost ETFs such as SGOV or BIL, which track short-term government securities. Rolling 3-month T-bills means your capital is never locked up for long, maintaining maximum flexibility. You can access and rebalance within months, not years. Countering the objection, why not go longer term for higher yields? Research into Berkshire's model reveals precisely why Buffett avoids long-duration bonds. A 20-year bond bought today could lose 30 to 40% of its market value if interest rates rise significantly, and you would have locked your capital away for 2 decades. Short-term bonds sacrifice some yield for something more valuable, capital stability and optionality. At 70, optionality is everything. The psychological shift. Having a defined, liquid, 100% safe pool of capital provides what behavioral economists call a risk anchor. When the S&P 500 drops 25% in a correction, your bond allocation hasn't moved. That anchor gives you the psychological stability to leave your equities untouched and let compounding do its work. The bond allocation earns you serenity. That has a financial value that does not appear on any spreadsheet. Pillar 3. Strategic cash reserves. The buffer against forced selling. Maintain 12 to 24 months of total living expenses in cash or cash equivalents, held in a high-yield savings account or money market fund, completely separate from your investment portfolio. Specific metrics. If your monthly living expenses, including healthcare, housing, food, utilities, and incidentals, total $4,500 per month, your target cash reserve is $54,000. 12 months to $108,000, 24 months. Hold this in a high-yield savings account currently offering 4.0% to 4.8% APY, such as those offered by Marcus, by Goldman Sachs, Ali Bank, or similar FDIC-insured institutions. At 4.5% on $80,000, that is $3,600 per year, earned while your emergency buffer sits on standby. Actionable example. Sit down this week, not next week. Now this week, and calculate your true monthly burn rate. Include the things people forget: the annual car insurance renewal, the quarterly property tax installment, the biannual dental visit. Divide your annual total by 12, multiply by 18. That is your cash reserve target. Transfer the necessary funds. Label the account. Do not touch it, except for living expenses. Countering the objection. Isn't cash a terrible investment? Buffett himself says so. Correct, and there is an important distinction. Buffett holds cash at Berkshire as a strategic asset, not as a long-term investment. The Berkshire model treats cash as insurance. It is the premium you pay to avoid the catastrophic claim of forced selling at the worst possible moment. Your cash reserve is not your investment. It is your operational firewall. And the psychological shift, the moment you have 18 months of living expenses sitting in cash, your entire relationship with market volatility changes. A headline reading Dow drops 2,000 points shifts from a source of existential dread to mildly inconvenient background news. You have 18 months. The market has always recovered. You're not in danger. This shift from panic-prone to strategically patient is the most powerful behavioral transformation in this entire blueprint. Execute the transition to this three-pillar structure within 90 days in a specific, ordered sequence, specific metrics, and timeline. Month 1. Audit. Pull your full financial picture. List every account, every fund, every fee, every expense. Calculate your actual monthly burn rate with precision. Identify your total investable assets. Month 2. Build the cash pillar first. Before any investment moves, establish your 12 to 18-month cash reserve. This is your operational foundation. Nothing else moves until this is in place. If liquidating some existing holdings is required to fund this, do it now. Take the minor tax hit. The alternative, being caught without liquid reserves in a downturn, costs far more. Month 3. Reallocate investment assets. Move the appropriate percentage into a low-cost S&P 500 index fund and a short-term treasury vehicle. If your current portfolio is in a tax-advantaged account, this reallocation is typically tax-neutral. Taxable accounts require careful sequencing with your accountant to minimize capital gains exposure. Annual rebalancing. Once per year, ideally in January. Check that your three pillars are in proportion. If equities have grown and now represent 95% of your portfolio, trim 5% into T-bills. If the cash reserve has been drawn down to 8 months, replenish it from portfolio income. Annual rebalancing. Once a year. Set a calendar reminder and otherwise leave the machine alone. Countering the objection. This sounds complex. I'll need professional help. You may. A fee-only fiduciary financial advisor, one who charges a flat hourly or annual fee rather than a percentage of your assets, can help execute this transition efficiently. The keyword is fee-only, not commission-based, not AUM-based, fee-only. The difference matters enormously. The psychological shift, completing the full construction of this architecture, knowing that your living expenses are covered for 18 months in cash, your capital is anchored in short-term bonds, and your growth engine is running in the most efficient vehicle in the market, produces a specific kind of quiet confidence. That is the hallmark of the Berkshire methodology. Maintain the structure through market cycles, inflation cycles, and life events without emotional deviation. Actionable example. Create a one-page investment policy statement, a document you write for yourself, signed and dated. It states, I will not sell S&P 500 index fund holdings during a market drawdown of any size, provided my cash reserve remains above 10 months of expenses. I will rebalance once annually. I will not add speculative positions. This document is your contract with yourself. When markets drop 30% and every instinct screams at you to sell, you read the document. You made this decision when you were calm and rational. You trust that version of yourself, countering the objection. What about inflation eroding my cash? Yes, cash held long-term loses purchasing power. This is why the cash pillar is sized precisely to operational needs, not as a wealth-building instrument. The inflation fight happens in the equity pillar, where the S&P 500's constituent companies, consumer staples, energy, healthcare, technology, raise prices with inflation and grow earnings above it. That is your inflation hedge. The cash is your operational firewall, not your inflation solution. The psychological shift. Investors who survive 10, 15, 20 years on this architecture report a progressive detachment from financial anxiety that is almost meditative in quality. The machine runs, the contributions come in, the rebalancing happens once a year. The noise of financial media, which requires your fear and attention to generate advertising revenue, becomes irrelevant. You have built, as the Buffett principle describes it, a sleep-at-night portfolio, and the compounding continues quietly every single day, whether you watch it or not. Here is what is going to happen to 99% of the people who watch this video. They are going to nod. They might even take notes, tidy, organized notes in a fresh notebook, purchased specifically for getting their financial life together. They will feel a surge of motivation in this moment, right now, watching this, and then they will close this tab. And tomorrow, they will scroll past 3 sponsored posts for cryptocurrency, a guaranteed 12% returns investment scheme, and a webinar promising them that options trading is the retirement income solution they've been missing, and they will change absolutely nothing. The Berkshire methodology isn't complicated. That's the point. It was never complicated. Buffett has been saying essentially the same thing for 60 years. Buy durable, low-cost ownership of great American businesses, minimize friction, hold through the noise, maintain operational liquidity. Do not speculate. The plan works. The plan will continue to work because it is built not on trends or market timing or forecasting genius. It is built on the fundamental, immovable reality of how compounding capital and durable business economics actually function. The reason 99% of people don't implement it isn't ignorance, it's discomfort, the discomfort of moving money. The discomfort of simplicity when the financial industry has convinced you that complex is sophisticated. The discomfort of inaction when your brain demands that you do something. Now, the mirror test. Look at yourself honestly. Is that person going to execute this plan? Because if yes, not someday, not when the market settles, not after the holidays, then the path is clear. Step 1 is simply this. This week, pull your full financial statement and calculate your true monthly burn rate. That's it. One piece of paper, one number. That is where this architecture begins. The Buffett principle, distilled to its essence, is this. You do not need to be brilliant to build lasting financial security. You need to be rational, patient, and boringly consistent in a world that rewards neither patience nor boredom. The market is open. Yeah, the index funds exist. The T-bills are available. The only thing standing between you and the architecture is the decision to build it. Not next week, not next month. Today.